I would like to turn it over to Ed Slott to share with us what he thinks are some opportunity strategies and pitfalls in the IRA space.
Well, thanks, Jeanette. I'm honored and proud to be here with you because one of my missions early on, I had a situation maybe similar to yours in a different way. I don't sell any stocks, bonds, funds, insurance, annuities, none of that. I'm a CPA, a tax advisor. It's what I've always been. But I realized in my career when I was dealing with people in their tax planning and their tax returns that over the years, as they were coming out or preparing for retirement or coming out of a plan or an IRA, they had no information, exactly like what you said. I would send them to their financial advisor and say, well, you better get some advice on that. And they said, well, they don't do that. All financial advisors use the common disclaimer, which, by the way, I see it today. Oh, we're not tax advisors. We don't touch that. It's like kryptonite or something. We don't touch any of that. And I realized there was a void and people were getting hurt. They were making terrible tax mistakes after 30, 40 years of working. Exactly your situation, and then they come out and some advisor can only advise them on investments. So even if the average advisor, let's give them credit, let's say they do well and they make them a lot of money, that's only half the game. When it comes to taxes, it's how much of that money you keep that counts. Taxes is the difference between how much of your money you get to keep and how much goes to the government. So they weren't playing what I call the second half of the game. A good analogy that's commonly used is people climb up Mount Everest, and they get to the top and they say, I've done it. And they didn't have a plan to get down. And I don't know if you saw a couple of years ago, there was a big story of all these people dying on the way down because there were no guides. And they were literally dying on the way down. They had no out and they had no exit plan. It's the same thing here. So you may be on top of the hill like Jeanette was, and I've got my defined benefit plan and my 401k. And now what? How do I keep it? Well, that's when all the taxes hit. So the first thing you have to know is that taxes are the single biggest factor that will separate you from your retirement dreams. But the reason I'm here with advisors like Jeanette, back to my story, I realized there was a void. Clients were being underserved and making horrible mistakes. And I only found out about it, like most accountants do, after it was too late. They came in at tax time and I would be constantly saying, oh, you know what you should have done? You know what you could have done? Oh, too bad you didn't do this. And it hit me, who needs an advisor to tell them woulda, coulda, shoulda? So I realized, and this was 30 years ago, over 30 years ago, I realized, we have to get out if we want to serve people in retirement or approaching retirement. We have to get out in front and not be reactive. In other words, I realized that my own profession, which is still the case, CPAs, tax advisors, most of them, sorry to say, are history teachers. They tell you what already happened. What is that? Here's what already happened. That's reactive. I realized I needed proactive planning, how to change what could happen. And that's when I got into all of these rules, especially, actually, it came right after the 86 Tax Act. So you're talking almost 35 years ago, when all these rules came out. And the Congress and IRS realized at some point people are going to be tapping into their 401ks and IRAs. We have to write rules for this. And they were so complicated. They're still complicated and nobody understood it. At that time, I was a younger guy too, in my 30s. I said, this is an area where you could help lots of people. And there's absolutely no competition as a tax advisor to focus on the taxes affecting retirement accounts. You want to know something? That was a good move for me, and it's still the case today. There's an immense shortage of advisors like Jeanette here that actually can tap into the tax specialization. And so what I did over the years, about almost 15 years ago, I created what I call an advanced study group. What I started doing, I built up expertise in this niche, finely specialized area, and started training advisors all over the country. And some advisors started to realize, not many, not most, started to say, you know, I need to do better for my clients. I need to do the full workup, not just invest their money and make them money, but help them keep it and pass it on. You know, my mantra has always been the key to a good plan is to have more, keep more, and make it last. So I started this group that Jeanette is a member of, and that's why I'm proud to be here with her, called Ed Slott's Elite IRA Advisor Group. It has nothing to do with investments. Our advisors, we're an education company, which I've always been, other than my tax planning practice, which I don't have anymore. I focus everything on our education business, to educate advisors that want to be educated. Here's the sorry truth. In my travels and my experience, most advisors do not want to know about this. They still cling to their disclaimers. I don't want to know about taxes, when taxes is the single biggest factor, like Jeanette said. So I'm telling you, 99% of advisors out there don't have the knowledge you need them to have. And that's why I started this advanced educational study group. Now, you might say, listening to me now, say, Ed, come on. Are you saying only 1% of advisors know anything about this? No, it's much less. I rounded up. I see how bad it is. I saw it as a practitioner 30 years ago, 20 years ago, and it's still the case. So what our business model is to find advisors like Jeanette and a few others around the country, only about 400. I don't know how many financial advisors, if you count attorneys, accountants, financial advisors, maybe 1 million. So maybe only 400 out of 1 million are at this level, the level you need them to know, because the tax code is very complex in this area. It's a specialized area, and the worst part is it's unforgiving. You have to get the right answer the first time, and that's why Jeanette joined this group. Now, she's been studying with us, and when I say she's a member of our group like our other members around the country, this is not one of those situations. I hear this from advisors all the time. They take some online course for an hour and they put all this alphabet soup after their name. This is on, yeah, they take an online course and half the time they're reading the paper doing the thing. And they put in all these credentials. It's meaningless. What we're talking about in this advanced education program is continuous study, in-person workshops, except for this year, but we're doing our virtual meetings next week. We have 2 full days. Jeanette's going to be attending 2 full days of virtual meetings next Thursday and Friday. And this is what they do all year long. We're constantly in touch with them when anything breaks. We want to match our business model because of what I saw in the past. And the same thing that Jeanette has found as a person working at a company and retiring from that company is there's a void. There's still a void. So our business model was to match competent, specialized advisors with clients who need these services and are not getting them from their average financial advisor. And that's why I created this group. And that's why when Jeanette called and said, can you be on the program? Sure. I want to spread the message. In my perfect world, shouldn't everybody with a retirement account, whether it's an IRA, a 401k, a 403b, a 457, shouldn't they have access to the best minds in the country that specialize in this area? Here's an analogy that may be better understood, Jeanette, and to everyone there. When you go to a doctor, you have a general practitioner doctor, and he or she, they're a nice guy, but they're not a cardiologist. They're not a neurologist. You know, sometimes you need a specialist, and you understand that in the medical profession. Well, it's the same thing with your money. Nobody's ever going to care about your money more than you. And you owe it to yourself to have an advisor that invests in their education. One of my golden rules when consumers ask me, I say, you should never invest with an advisor that doesn't invest in their education. And I'm not talking about their sales education, how to sell more products. I mean what Jeanette is doing here, their education to help you keep more of the money you earn. The same problem you had, Jeanette, when you started out, you also realized there was a void, and you created needed a solution in your own way. And now together with our backing, you have access to resources unheralded. There's nothing like it in the whole country. The level of education and information, especially now in these uncertain times when things are changing rapidly, you're in the loop. You know, I call this, I just came up with this term a couple of weeks ago when I was talking to one of our other advisors on a program like this in Arizona. I said, this is like the financial Olympics. Jeanette, because you've been with us and training, you've been training for this moment for over 10 years.
Absolutely.
That's the kind of advisor you need at this critical moment. Not that Johnny come lately, someone said, oh, I heard about it somewhere. Let me sell you some stocks. This is the financial Olympics, and you want somebody who is capable of the gold medal.
Yeah, it's exactly right, Ed. And that really speaks to the value of depth of knowledge, not just surface knowledge. But, you know, it strikes me that we've been getting a lot of questions about the loss of the stretch, which came out of the Secure Act. And now we have the CARES Act. There's been some changes. Could you give us a little snapshot of maybe what is on the horizon, what has occurred since just January of this year to current, and what how that impacts retirees and pre-retirees?
Well, it's critical now. Let me go back to my first discussion on taxes, because the first thing everybody has to understand, and it sounds simple, but some people don't get it unless you explain it, the difference between tax deferred and tax free. And it's a big difference. But that big difference comes down to one little word, and that word is yet, Y-E-T. Tax deferred means you won't pay taxes on that money yet, but you will at some future time, maybe at higher rates, probably at higher rates. Tax-free means you'll never pay taxes on that money. As a tax advisor, I have certain always rules. You know, not everything we say on this program applies to everybody, but certain rules do. And one of my always rules for my whole career as a tax advisor is this: tax-free is always better. In all my years of working with clients, over 40 years actually, I never had a complaint from a client saying, this is all tax-free. I want to pay and you won't let me. I never had a complaint. Tax-free is always better. Now, it's even more important to get to tax-free. And I like to use one of the sayings I use on my public television programs: moving your money from accounts that are forever taxed to accounts that are never taxed. You want to move from tax deferred to tax free. Now, there may be a cost to that, but today may be an opportunity to do that. So it's very important to get into tax-free vehicles like a Roth IRA, like cash value life insurance. And I don't sell life insurance, but tax-free becomes even more valuable as tax rates increase, which I suspect they will. I always thought that. But given what's going on in our country now, you have to look at what's going on. Let me bring it down to a personal level. If somebody listening, some of your people there, Jeanette, are listening or watching us now, and I said, let's say you have a bank account. It may have happened to all of us, and for some reason, you're overdrawn. You have no money in it, and you write a $50 check. What do you think will happen? It will bounce. That check won't be cashed. So now let's compare it to the government. They also have a bank account with no money in it, actually in deficit, overdrawn. And a couple of weeks ago, they wrote a $2 trillion check on that account. What do you think will happen? Where is the money coming from? Right now, they're just printing it. But at some point, the taxes will, that's the only thing that finances our government, will have to be increased. So your retirement savings, and that's what Jeanette was talking about, the tax time bomb, it was there before, but now it's intensified because of what is looming. High taxes. You don't know how good you have it right now. We're in the lowest rate you may ever see in your lifetime. Now is the time to take action and get a meeting with Jeanette if you aren't already scheduled to do it, because so many things have changed, and find a way to get more of your money into tax-free territory before they lower the hammer on you, and rates could easily go back up to 40, 50%. And that's the worst because not only a high tax rate's bad, but it's worse when you're in retirement and counting on a certain amount of money when the paychecks have stopped. So now, Jeanette, you mentioned the Secure Act. That ended. That's more on the estate planning angle. And many of you have set up estate plans for your IRAs or 401ks who will get the money. That's what an estate plan is. And I've been reading now more people running, actually not running, or going like online to their attorneys trying to get a estate plan because they're all worried about the virus and who knows. And they're doing these online meetings actually with their attorneys and estate planners. But the plan for the IRA has changed. If you have an IRA and you haven't updated your plan in 2020, you need to make an appointment immediately because the plan you thought you had doesn't exist anymore, except for certain exceptions, which is not most people. So many people leave their IRA or their plan to their spouse. That's still fine. The spouse is always the exception. There's no problem. But eventually, either you are already single or widowed or don't have a spouse. Eventually, one spouse is going to die, and at some point, it's going to go to a non-spouse, a child or a grandchild. That's when the Secure Act limitations kick in. There used to be something called the stretch IRA. All that, it doesn't really exist in the law. I always used to get a kick out of when people would call up when I was doing more advice and tax planning for people. They would say, I heard about this stretch IRA. I went to the bank. They don't have them. No, it's not a product. It's a process. All it meant was the ability to name a beneficiary, say, you know, a 20-year-old grandchild as a beneficiary. If they're named on the beneficiary form, after you die, they could stretch or extend distributions, taking out little amounts, small amounts, over maybe 60 years with all of that money building up. And it could be done with a Roth IRA tax-free. All of that is pretty much gone now. The Congress thought they wanted to make a lot of money. Again, they needed money. And this is a lesson to everybody listening to me and why it's critical to make an appointment now and get your new estate plan, either review it and probably revise it or scrap it all together, because Congress has constantly tipped their hand. Remember, I said all these 401ks and IRAs, they're loaded with taxes. They're tax deferred. That money has not yet been taxed. Well, Congress tipped their hand again with the Secure Act. The minute they reach in and they realize they need money, the first thing they go for is your retirement savings. They raid your retirement account because they know that's the low-hanging fruit. It's like a juicy steak to Congress. All of that tax money is just waiting for them. So whenever they need money, that's your sign. That's where they're going. So now they changed in the Secure Act. They did away with the stretch IRA for most beneficiaries, except for a spouse, and replaced it with a 10-year rule, which means most of your beneficiaries, your grandchildren, your children, your friends, anybody but a spouse, will have to cash out that account within 10 years after death. And if you had a very large IRA and may have left it to a trust, most of those trusts will no longer work. Now, Jeanette is very well informed on that. She's been through webinars and training, and we're going to hammer her again next week with 2 solid days of meetings and examples on which clients really need to update their estate plans, especially if they've named a trust. Most of those trusts won't work anymore and will actually accelerate taxes at the highest trust tax rates. And it may go to your children now, who, when you die, may be in their peak earnings years themselves. Maybe they're in their 40s and 50s, and maybe at future higher rates. So it's a double hit. So when you talked about that time bomb before, Jeanette, it's going to be worse, but there's a silver lining now. There's an opportunity, a window to make a change, to update your plan and have a conversation. That's number one on my list of advice. See where your money is. Is it in tax deferred? How much is in tax free? And sit down with somebody like Jeanette, who has the knowledge that most other advisors in this country just don't have access to. So that's why I'm proud to be here, because I want people to keep more of their retirement savings. And the only way you're going to do it is to have somebody with this kind of specialized knowledge.
Okay, there is...
that was a lot to unpack. So.
Oh, I love it. I'm going to tap into it. I'm not going to let you go away. I know you have a full schedule of commitments, but we have in your chat box, some of you may have questions and they're specific to you. You can go ahead and put them in the chat box. We're gathering them, and I will commit to you that we will reach out to you and answer those questions specific to your unique situation. So fear not, we are going to get to all of your questions. I know they're coming in, a lot of the questions, but I just wanted to kind of keep this general. Also in the chat box, Ed has referred to, you want to get a consultation. We are offering a complimentary consultation to all of you listening, clients, non-clients, everyone. There is a Calendly link into the chat box, and if you go into it, you can claim your spot right now. It's a 30-minute time slot, and just go in and register for a 30-minute consultation. And we call this our discovery model, our fit model, just to see how we can best help you, so we can make sure we're prepared for you when you want to do the full plan. And Ed said something very critical. He said your estate plan. A lot of people, what you see behind me is Petros Financial Group, Tax and Wealth Advisors. We are a fully integrated firm. We believe in 4 cornerstones of planning. We're not just talking about the tax plan. That's a very critical component. But we also focus on your estate plan, making sure you have the right estate plan, and working with that Slott's group. We do a lot of due diligence on beneficiary audits, because you might have the greatest estate plan in the world, and then you have not updated those beneficiaries in accordance with that estate plan. And so we handle the tax planning, the estate planning, the healthcare planning, and the financial planning. So that's very critical. We consider that the 4 cornerstones. So we're here today. Ed already alluded to 2 of the most critical components of your integrated and holistic plan, and that is the estate plan and the tax plan. So with that, Ed, more recently, we've seen a waiver of RMDs, and we've seen a couple other things from the CARES Act. And I know you and your team have had your sleeves rolled up, and y'all are because every morning at 4:30, before I wake up and do my prayer and then start on my workout, I sign on to my emails, and there's emails from your office. There's the Slott report. There's the mailbag. You're constantly, daily giving us information. So could you share with our audience some of the impacts that you can see in the CARES Act?
It's funny. Now that was signed into law March 27th. To show how updated you are, obviously we were looking at the bill and we had it all written up and waiting for the button. And it was, I think, Friday, March 27th. And we had the alert going out to you with all the provisions. And I was on with my team, and they said, should we send it? I said, no, he didn't sign the bill yet. He didn't sign the bill yet. I think it was like, I don't know, 4, 5, 6 o'clock at night. As soon as he signed it, I said, all right, hit the button. And you got it within minutes of it becoming law. Now, that's the kind. Now, most advisors don't have access to that. That's my point to everybody on here. And just an aside, I can see some of the questions, and some of them do apply. Somebody asked about a trust deed IRA. There were a few questions about trusts, because I made a comment that most trusts won't work, and that's why you want to see Jeanette here. But somebody asked specifically about trust deed IRAs that come from banks often. Those generally will not work after the Secure Act, because they're set up as conduit trusts, and every reason that you had that is out the window now. They will have to revamp those trusts. In its existing form, they won't work, because it forces all the money out to beneficiaries in 10 years. That's the reason you had a trust, to protect it from beneficiaries. And for all kinds of problems. This is one of the things in all my years in doing estate planning with clients, just like yours. I don't do it anymore, but I can tell you one common thing. When I would ask them, and I'd sit down with them, I said, what is it? Why are you here? Why are you here? What's your wish list? And it would be somebody maybe that had a large IRA. Maybe they had saved $1 million or $2 million, in an IRA from 30 years of working at a company, one paycheck at a time. And all of a sudden they have all this money. And they would say 2 things. I want this money protected after my death. The last thing I want is to this money to go to my kids or grandkids and have them squander it 5 minutes after I drop dead, after it took me 40 years to build it up. The other thing I want less taxes. So I want more control and less taxes. So this trustee IRA or a conduit trust, somebody asked why does a trust not work, would undo the intent of the average person's wishes, because if you've accumulated a lot of money, you might need a trust. So these trusts that existed before the Secure Act would have paid out and protected the lion's share. But now, under this 10-year rule, everything on these conduit trusts, and if you want to know more about that without getting in the weeds, that's what Jeanette has plenty of information on that. And she has us as a back office. That's a huge advantage over any advisor in the country. But all of that money would go out to the very beneficiary they were worried about. That could be you and your kids. And I'm not saying all the kids are bad, but every kid, every beneficiary has issues. You could have a minor as a beneficiary, disabled beneficiary, somebody who doesn't understand money, is frivolous, is a spendthrift. Maybe they're going through bankruptcy, a divorce, they have lawsuits, or you feel they're vulnerable to people preying on them because they've come into some money. These things need to be protected. The current trust you have that will pay out all the money to them will leave it exposed. So that has to be fixed. So that, I see some people ask, what's the bad thing that will happen to my trust? Two things that will happen. It'll either all go out to the beneficiaries and be exposed, the very thing you didn't want, or with different kinds of trusts, it could stay in the trust, but then it would be taxed at high trust tax rates. So either way, the plan has to be revised. And one of the options might be with a Roth IRA. So now a Roth IRA goes into the trust to eliminate the tax, or scrap the whole IRA for a better plan, which I think is a better plan, using a permanent cash value life insurance. Now, I don't sell life insurance, but I did that for myself because I see it as a better long-term plan, more stable plan, doesn't rely on all these changes of tax laws. This way, if you leave insurance to a trust, you can do whatever you want. You don't have the trust tax, you get the post-death control, you get the tax-free, and you actually get larger inheritances. So there are solutions that our advisors like Jeanette are well versed in. Most people are not talking about these things. They're just looking at the market and all the doom and gloom. We're here planning for when we come out of this. You know, the doom and gloom is, you know, it's enough with that already. Yeah, it's bad out there. I acknowledge that, but I don't need to be bombarded with it. I want to look beyond that. And that's what Jeanette is doing with this program, looking beyond and creating a plan. So now we have the CARES Act you finally asked about, where RMDs are waived. That could be a good thing. You don't have to take your required minimum distributions in 2020. But Jeanette, if you sit down with Jeanette, she may say, you know, you don't have to take it, but maybe you should take some voluntary distributions, even though you don't have to. You might say, why would I ever take money I don't have to take? Because you might be able to get it out at today's low rates. For tax planning, it's all about getting your money out at the lowest possible tax costs. Look, you go to a supermarket or you buy a major item, an appliance or a car or a home. Everybody wants the lowest price on everything. Well, I would say your retirement savings is a big ticket item purchase. You want the lowest price on that too. And that may be a reason. I mean, you know, Jeanette has charts like this that we give her. I don't know if you could see this, but she has access to all our charts and you could see the tax rates. I mean, you could stay in the 22% bracket for a married couple filing joint up to $171,000 of income. If you don't use up those low brackets, they're wasted and they're gone, and you don't use them, you lose them. So you also have an opportunity maybe to do some Roth conversions. When there were RMDs, you couldn't convert the RMD. Now that there's no RMDs, maybe it pays to have a conversation with Jeanette or one of her advisors and look at the opportunities, look at the silver linings. You know, Roth conversions are at a premium now. Actually, they're on sale now. It's a good move, I mean, by the word premium, because you have two factors. You have low values in the market, relatively low, and low tax rates. both of which will probably go up. The market will rebound and tax rates will go up. You don't want to do a Roth then, you want to do it down here. Well, you get the best buy for your money. So even though all the media is talking about, yes, you don't have to take RMDs, but what's the real play? The real play is to speak to an advisor on what you can do to pull some of that money out of your IRA at the lowest possible tax cost. That will always leave you with more money.
Exactly. Thank you so much for that, Ed, because see, the key message in everything that Ed shared, and the key message in everything that me and every member of my team shares is it's all about planning. It's all about the plan. It doesn't have, excuse me, I use simple language. I'm not, I'm not a brainiac, but all I know is if you fail to plan, you plan to fail. And the plan is what determines how to leverage the tax code, how to leverage estate laws, and how to ensure that you keep that hard-earned money, that dollar in your pocket. And so it's the plan, that integrated plan that we pride ourselves in. We pride ourselves in doing the plan. Folks, it is more than the money. When I say one of the taglines of our company, it's about total well-being. It's more than your money. Your money is simply a means to achieve your dreams and your goals, and the dreams and goals you have not only during your lifetime, but for your beneficiaries. I honestly, I thank God I'm affiliated with Ed Slott's organization, because there are some weird things that people do to their IRAs, and they are just very unusual things. And we have access to Ed and his entire team of technical consultants to get me to the right resource. And within hours, I get information out of Ed's office, because there are unique life situations that necessitate more advanced planning. And I encourage you to go into that chat box, select a time slot for your complimentary consultation. What we have here, and one of my favorite tools, is Ed Slott's Retirement Decisions Guide. This is my Bible. In fact, we have a CPA out of my Orlando office. We partner with different CPAs in our different regions, and she says that this has become her Bible. This is a CPA that looks to us, and I'm praying, because I asked her to sign up for this webinar. She's saying that this is the type of information that we are able to give our CPA partners faster than the speed of light, even sometimes faster than they get it out of the CPA professional organizations, because Ed is directly connected to Washington, to Capitol Hill. He's directly connected to all the financial media, which is why they go to him. So we are offering you with your consultation, either some of you who have already received, because I use it very freely, the 2020 Ed Slott Retirement Decisions Guide.
Just out.
Retirement Done Right. Retirement Done Right is a book that talks about don't just invest, but plan. And it talks about the cornerstones of appropriate planning. And we'd love to extend our invitation. We want to give back, because everybody's sitting there thinking that there's doom and gloom. But I'm with Ed. I have such a spirit of anticipation and helping every individual that's listening, that we can get through this and we can come across better, and you'll have more money in your pocket. I can't guarantee that, but what I can say, with the proper plan, you can achieve it. So again, we have in the chat box, we have the link to go schedule your complimentary consultation. You have questions. If we didn't answer them, that's okay. We will personally commit to getting out to you directly and answering that question. Ed, do you have any final thoughts?
Yeah, there's one point that I think I see some questions, but this is more of a general item. I talked about trusts. Obviously, most people don't name a trust as their IRA beneficiary. They name individual people, their children, their grandchildren. So somebody asked, well, I heard you talk about all the problems with a trust, but I have individually named beneficiaries. Do I have an issue? Yes, the same rules apply. It's just worse with trust because there's more layers of complexity. But for example, let's say you name that 10-year-old grandchild straight out. and you thought they would stretch it out for 70 years. That's not happening. The 10-year rule still applies. You may want to speak to Jeanette or her team about maybe looking at changing the beneficiaries or moving the IRA, like I said, more of a life insurance plan, or do more Roth IRAs. The Roth IRAs are also subject to the 10-year rule, but the plan will have to change because of the Secure Act. It applies to almost all non-spouse beneficiaries. A trust is a non-spouse beneficiary, and so are your children and grandchildren. The only exempt person is a spouse. But eventually, like I said, the money's going to, that's what Jeanette is talking about, planning long-term is going to end up, unless you spend it all, which would be great. That would be the perfect plan. You write your last check, as they say, on the ending balance. But it's more likely money will be left. And when IRA money is left to children or grandchildren, you're going to need to revise the plan based on the changes in the Secure Act, which are effective now in 2020. So if you're still breathing, if you're watching this, don't keel over now. You're still breathing. You still have time to fix anything.
Exactly. Thank you, Ed.
Thank you. And I'm proud to have you as one of our members, and the way you invest in your education. That's why I do these programs. In my world, nobody should be working with an advisor that doesn't have the specialized knowledge like Jeanette has that you need them to have, and most don't. But we're changing that, me and my team, one advisor like Jeanette at a time. So thank you for having me on.